Welcome everyone for our fourth quarter US 2021 US equity outlook, focusing on the big tech. My name is Timothy Ang, research analyst at PhillipCapital Research, and together with me, I have Jonathan and Weiren, all in part of this US team. And so today's webinar, the outlook for the US tech, is titled "Secular Tailwinds in Tech," because we think that the underlying drivers behind tech is still continuing despite the recent headwinds that have been occurring in the market. So basically, the picture here shows a rocket. So the rocket boosters are still on, obviously. Okay, so before we move on, we have a disclaimer. So whatever is spoken here is just for information and does not constitute any it's for educational purposes. Okay, so before we start, we will just go through the review of the third quarter, the most recent quarter, the performance. So we saw last quarter that the market was taking a breather, so it was just pausing. So this chart just shows the performance of the various asset classes in the US. So the first column shows the FANGs, which is Facebook, Apple, Amazon, Netflix, Google, and Microsoft. So these are the biggest tech companies in the whole of the US. So we lump them all together and call them the FANGs. Then we also have the S&P 500 and Nasdaq, and then the other asset classes, which is bonds, gold, and commodities. So all mostly flat asset commodities. So you can see commodities are up 7.2% for the last quarter. They did well because of the improving demand for the when economies are reopening after the pandemic. So there's a renewed demand for commodities. But I think the others are mostly flat, mainly because of higher interest rates. So in September, the Federal Reserve actually guided that interest rates may rise a bit earlier, like 1 year earlier than expected. So the high interest rates, which theoretically should slow down economic growth, actually impacted stocks as well as other asset classes like bonds also. But year to date, the performance for stocks is still fine. So the FANGs were up about 23%, S&P, Nasdaq up around 20%. So for sector-wise, in the US, the sectors, we see financials did well, mainly because of the higher interest rates that we saw during the last quarter. But consumers, the consumer sectors were the laggards, mainly because the pandemic support programs by the government started tapering off last quarter. So the stimulus checks and stuff started stopping. So basically people had less money to spend. So the consumer stocks were lagging. Okay, but for the within the FANGs itself, the big tech companies, Netflix did well, mainly because of more subscribers, and also they managed to increase prices also for their subscriptions. We'll touch more on that later. The laggard was Facebook, but it was down only slightly, mainly because of the negative publicity with regards to its whistleblower and also some privacy updates, which makes them a bit harder to gather user data, and that affects their ads business. So we'll also touch more on that later. We just wanted to add this chart here because the theme that has been playing off in the US recently is interest rates. So rising interest rates mainly. So it's causing a bit of worry in the markets at the moment. So we look at the historical performance of interest rates and the stock market. Basically, the shaded areas in this chart, you see the beige areas is periods where the interest rates actually spiked up. Interest rates is the red line. So during those shaded areas, the interest rates actually spiked up. So whenever the interest rate spiked up, we see that the relationship of that compared to the stock market, which is the blue line, the Nasdaq, the tech index, the relationship is quite unclear. So it's basically, even though theoretically interest rates should slow down the economy, but then markets can still go up even though interest rates spike. And in fact, during the 2020 pandemic last year, when interest rates actually dropped a lot, the stock market also dropped a lot at the same time. So the relationship there is quite unclear. But we think that mainly economic conditions are more important to the stock market performance rather than interest rates. So this is just the chart that we wanted to show you, that markets can still perform when interest rates are rising. And the second chart we wanted to show you is with regards to valuations. So it's just a gauge to tell you how expensive the current stocks are currently, historically. So, I mean, with the stock market at a historical high, people are quite worried that they are buying quite expensive. So we wanted to show this chart here. The blue line is actually the valuations for the FANGs, so the big tech companies. So it's just a gauge to show you how expensive. So it's come down in the past 1 year. So, and it's recently trading around very near the 5-year historical lows. So, and in fact, the broader Nasdaq index, which is the red line, the broader market, the tech index, actually got relatively more expensive. So what the point is for this chart is that we're thinking that if you want to buy the FANGs now, we think that you're not overpaying if you buy more at the moment, because the premiums now is quite low compared to the overall tech market, firstly. And secondly, is because you're paying a lower premium for market leaders. Instead of buying the overall broader market, you're buying the market leaders. So you're paying a more narrow premium. So we think that you're not overpaying if you're buying at the moment. Okay, so we'll move on now to the sector themes that what our webinar is focused on. So the picture here is it shows you a wave. So we think that the trends now are like a bit unstoppable, like this wave here. So because we think that they're still intact. So the first trend is cloud computing, and our title is a steamrolling, which means that it's just growing really fast. So for those of you that are not really clear on what cloud is basically just the internet. It's just a fancy way of saying internet. So now we're doing Zoom, right? You're watching this webinar over Zoom. So actually you're using the cloud now because you're watching Zoom, this webinar, over the internet. If you watch YouTube, it's over the internet, you're using the cloud also. If you watch Netflix, you're also using the cloud. So all these applications rely on the cloud, and which basically relies on the internet and relies on data centers. But the difference now is that for, let's say, Netflix, they don't own their own data centers. What they do is they pay Amazon, like they pay other cloud providers like Amazon to use their data centers, to use their cloud, so that they can broadcast and expand their operations all over the world, to all over the countries, so that everyone can watch their shows anywhere they want, right? And so this is the new theme. The trend is that everything is moving to the internet nowadays. There's no more CDs. You don't have to buy any CDs. You just can use it on your phone, right? If you're working, you have Microsoft 365. You don't even have to download the applications like Outlook and stuff on your computer anymore. It's all done online, and that is all done on the cloud. And not to mention now, after the pandemic, everybody is going to remote working, and so all the companies now really have to rely on internet and remote working, and many of them are actually don't have the capabilities and don't have the time to actually scale up into their own data centers. So they're paying companies like Amazon and Microsoft to use their data centers rather than their own. So this trend is expected to accelerate even faster. So it's growing at double digits compounded annual growth rate. And just as a context, Amazon's cloud business actually grew 37% just last quarter. So this is how fast the cloud is growing. And not to mention the new applications for clouds also, they are not yet in the market at the moment, which is autonomous vehicles that rely on the internet just for your car to work. Okay, so this chart just shows you the forecast of the IDC, which is the international data. Sorry, it just keep on. But it's just a organization in the US that forecasts all this IT spending. So they forecast it to continue. The trend is a parabolic trend over the next 4 years. The next trend we see is in a smartphone. This is particular to Apple. So we see a new 5G super cycle. I mean, so the smartphone market is getting a boost from this 5G new 5G technology. So firstly, there is higher smartphone volume sales. So you can see in this chart from 2020 to 2025, there's an uptick in volume as people replace their 4G phones with new 5G phones, and also the telcos are like more aggressively selling 5G devices because they want people to use more of their more expensive 5G services, right? Okay, so but the volume we see moving forward is not going to be as good as what we saw back in 2010 all the way to 2015. Mainly because it's already very saturated. Everybody already has a phone nowadays. So, but what's more important about 5G is the pricing. So the pricing will increase. The 5G phones are much more expensive than your regular 4G phones. Higher about more than 20% higher. Right. So because everybody next time will have to start buying 5G phones. So that's going to help companies like Apple. So this is the 5G super cycle that we see for smartphones. So my colleague Jonathan will take over for digital advertising.
Thanks, Tim. Right, so for digital advertising, we continue to see a shift towards digital advertising. Because nowadays nobody really reads the newspaper or print magazines anymore. No one really watches linear TV anymore as well, and most of how we spend our time consuming information is through like phones, tablets, or computers. And so advertisers also know this trend, and it's kind of why advertisers are spending more money on digital ads compared to like traditional print ads. And the pandemic has also accelerated this theme because there are more and more businesses moving online and doing their advertising online. So it's kind of helped this push to digital advertising. So right now, digital advertising is only about 58% of total media spend. So we see that there's kind of a bit more runway to grow, to increase their penetration. And it's also evolving. So instead of just your regular ads on your web pages or like on Instagram, nowadays they are kind of evolving into like short form video ads. So you probably get to see a bit more like short form video ads on your screens instead of prints. The two main giants for digital advertising are Facebook and Google with more than 52% market share. And just a bit of context here, Facebook's ad revenue growth was 20% last year, so it's growing pretty quickly. What we are looking at right now is actually the emergence of Amazon, which Tim will discuss a little bit more as they are moving and spending more on their digital ads. So overall, this is not really a new trend, but it's a trend that's very much intact, and we continue to see this moving forward. So moving into the next trend that we see, it's video on demand streaming, and it's a shift away from linear television. So just in case you guys didn't know what video on demand was, it's like your Netflix, YouTube, Disney Plus, Hulu, and linear TV is your broadcast, your cable TV, your traditional TV. So we see a continuing trend of this expanding streaming market, and this is for a couple of reasons, and it's definitely led by shifts in consumer viewing preferences. So everybody nowadays wants on demand because it's a bit more flexible. You don't have to wait for your favorite TV show. You can kind of just watch it on the go as and when you want. And also, generally, there's a larger variety of content on these streaming websites as compared to regular TV. Another reason for growth is that there's actually been improving cloud infrastructure to support hosting these contents, and also increasing broadband and mobile broadband internet speeds so that you can actually stream these content on the go, without buffering, without lag. So we see these macro shifts as boding really well for Netflix and Google because of YouTube and obviously Netflix. And we definitely see this improving moving forward. So next theme would be regulation. So specifically like antitrust regulations. This chart on the left here, it's basically like a compilation of all the fines in the past few years that have been received by the big tech, like Facebook, Apple, etc. There's actually quite a lot of news regarding antitrust lately, and it's mainly for two underlying issues. So the first would be monopolistic practices, and the second would be anti-competitiveness. So just for monopolistic practices, a little example would be like a market leader acquiring a smaller company that has just entered into this industry just to maintain its market share. For anti-competitiveness, it'd be a bit like right now what's going on is that Apple kind of has this issue with their Play Store where they're not letting in-app purchases kind of go around them. So everything has to go through Apple, and they're taking a big fat commission off that. So that's kind of your anti-competitiveness example. So most of the times, these kind of end up in fines, which we're not really worried about because, as you can see, it's just a small % of revenue every year. We're a bit more concerned about, and also the markets just kind of take it as a one-off. So, your stock price will drop a little bit for a week or 2 weeks, and then it will just take off after that. We're a bit more worried about regulations that may affect business models, but that's a bit tough to model, and so it is just a concern for us. But we do see a shift in kind of how regulators are taking aim at certain companies, and that's starting to affect their business models a little bit. So the latest case would be the Epic Games ruling against Apple. So just a bit of backstory, like Epic Games sued Apple for forcing all in-app purchases, like I mentioned earlier, to run through Apple Store. And obviously Apple took a 30% commission, which is pretty sizable. In the end, a judge ruled in favor of allowing app developers like Epic Games to provide links directing users away from, to provide like alternative payment methods. So they kind of bypass Apple Store, which in effect could affect Apple's revenue a little bit because it reduces the amount of revenue you can collect through commissions in the Apple Store. So currently there's a few antitrust cases going on. Facebook's antitrust case with the FTC, which is the FTC actually just wants to break them up because of their acquisition of Instagram and WhatsApp. There's also another Apple antitrust case with regards to their NFC chip, which because it only allows Apple Pay on your Apple phones instead of like Google Pay or other sorts of payment methods. And there's also a Google antitrust issue, which is similar to Apple's Play Store issue in terms of commissions. So moving on to our stock picks, I'll start first with Facebook. We have a buy rating on Facebook with a target price of $424 US. We see MAP growth, which is basically a fancy way of saying users, but it's monthly active people. So it's users that have used the app or platforms in the last 30 days. We see it growing 9% next year from growth mainly in Instagram and WhatsApp. And we already see that for the first half of this year, MEP is already up to 3.51 billion, which is a 6.4% increase from the end of last year. So not only is volume rising, but price is also rising as well, which is ARPP. We can see that we forecasted to grow 22% this year compared to last year. And it's partly because there are new ad formats and a higher placement capacity that Facebook is kind of putting out throughout its platforms. So have you noticed like nowadays there's a bit more ads and that you see on Facebook and Instagram, instead of maybe like one ad every few scrolls, now you're like every other scroll you'll see a ad in print form, in like static form or like a video ad. And this is all kind of contributes to the strong ARPP. So even like last year, you could see that the ARPP was really strong, increasing maybe like 10%, even as nobody was really, even during the pandemic when no one was really able to spend that much money on advertising. Besides the core business of advertising, we also are quite interested and quite buoyed by the growth drivers long term for revenues, new streams of revenues in e-commerce and AR/VR. So commerce actually was one of Facebook's fastest growing verticals last year, and the company is doing quite a lot to attempt to monetize it moving forward. So we see quite a big avenue for growth there in terms of revenue. In terms of risk, the largest worry would be Apple's recent iOS 14 privacy updates, which could and will actually affect Facebook's ad model, because it basically restricts or allows users to opt out of sharing their data with Facebook, and that means that Facebook's targeted ad campaigns are probably going to be less effective moving forward. But overall, the core business profits are still going strong, and that's why we still have the buy rating on it. Moving on to our next company, Netflix. We have an accumulate rating for Netflix with a target price of 724. Netflix is actually doing really well because their pricing is up, subscriber base is up, and content cost is relatively flat. So for the chart on the left, it's the membership versus revenue kind of comparison. As you can see, memberships are very important. As the membership base increases, so does revenue. And so, it's just it's a very linear correlation. Whereas the chart on the right is a little bit different. It's the ARM, which is essentially the price that you pay, the average price that users pay for Netflix service. So you can see that the ARM is actually increasing even as content cost is kind of remaining flat. So you can generally be able to see like a increase in your net profit margins moving forward. So we kind of see that the reason why the content cost is relatively flat is because of the fixed cost structure that Netflix has. So they actually they amortize a lot of their content costs, throughout the years, but that's mainly the bulk of their costs. So they just set aside, how X number of X billion for this whole year, regardless of how many members they have. And that means that the more members you have, once you reach an inflection point, every member that you add is just going to bring in a lot more profit. And it's kind of what we're seeing right now. So net margins actually grew 5 times over the last 4 years, from 2% in 2016 to 11% last year. We kind of expect this growth to continue moving forward, based on the stats I mentioned earlier. And the company also saw positive free cash flow for the first time last year, which is actually a really big milestone for them. So it actually allows them to finally self-fund growth instead of relying on debt funding. And there's also this extra potential for share buybacks, which is just a plus point for investors. So also, like, macro shifts in how people consume entertainment and their preferences definitely are helpful for Netflix moving forward. And that's why we're also quite bullish on Netflix. So for the next couple of stock picks, I'll pass my time back to Tim.
Yeah, thanks, John. Our next topic will be Apple. So it's the other big tech company. So Apple, they sell iPhones and MacBooks, but we like Apple because of the strong demand for its new 5G phones. So for the new iPhone 13, the pre-orders are actually as strong as previously back in 2015 when there was a 4G super cycle. So everyone was just buying new 4G phones. So now the volumes are higher than back then. So it's a new super cycle. So Apple actually ordered more units than usual. So they ordered 90 million units for the pre-launch versus the usual 75 million. And the lead times can be as high as about 1 month now. But of course, there's a supply chain issue at the moment, but it's still a gauge of the demand at the moment. But what's more important for Apple is the higher selling prices, which is, you can see the yellow numbers, the yellow line. So for 2021 this year, the average selling prices are up more than 20%, and that's because 5G devices they're just selling much higher prices than 4G phones. So this will definitely help Apple with their margins through this new technology, through 5G. For the supply, currently there's a supply chain crunch at the moment for the world, particularly for semiconductors. So this also affects their iPhones and other products. But we are seeing that Apple is this supply crunch is faring much worse for other smartphone manufacturers, simply because the suppliers are putting Apple in priority. So Apple takes priority over other customers, mainly because the Apple demand is just so high. They're selling 200 million units this year alone, and so they're faring better during this supply crunch. And secondly, as an added bonus to all this, Apple also uses a lot of their profits, the high profits that they get from this the new sales. They use it to buy back shares. So they use about 70% of all the cash that they earn, and they just buy back the shares. And this also helps to support the share price. So these are the various reasons why we like Apple. But we think there may be one overhang, which is the new anti-competition rules on the Apple App Store. So what the new rules are is that Apple cannot force users to pay for ads or pay for in-game, in-app purchases through the App Store anymore. So previously, people were only allowed to purchase through the App Store, and Apple takes a 30% cut of whatever you spend on the App Store. But now there's no rules there's new laws that say that Apple cannot force people to only pay through the App Store, so they can just pay through elsewhere also. And we see that other competitors are preparing already to undercut Apple by more than 50% of their fees. But we're still unclear on the impact, because people may think that it's more convenient to pay through Apple firstly. So we're still continuing to monitor this, but I think this will be a risk to Apple's business model because it affects how they make money through the App Store. But just an update that Apple is appealing against this. So the new rules will only kick in early December this year. But if Apple manages to win the appeal, this may be delayed for maybe a few years or so. So we are still monitoring the case. Our next topic, which is one of our favorites, is Amazon. So the title is much more growth ahead. So they have three drivers, right? But the main two drivers are cloud and advertising. But the third driver is e-commerce. So for cloud, Amazon, Amazon is like an e-commerce site, but actually they're also the #1 cloud service provider in the whole world. So, and the cloud market is still in very early stages. Only about 4% of the global IT spend is in the cloud. So there's much more runway for the cloud to grow. And we think that Amazon is going to capture much of this growth, simply because based on many analysts and reports and customers, right, Amazon is by far ranked the highest with regards to reliability and capabilities, firstly. And secondly, because their pricing is very much competitive compared to the closest competitor, which is Microsoft. But also more importantly, is because of their scale, because you need a lot of data centers to serve customers like Zoom, Netflix, and all these customers that reach throughout the whole world. And being the largest cloud provider in the world has its advantages in capturing this kind of customers. And that's why we think that Amazon will capture much of this cloud growth. And Amazon's cloud revenues are in fact growing faster than the overall cloud market. So up 37% in just the last quarter. The second driver is ads, advertising, digital advertising. So what they do is people can just advertise on Amazon.com, right, on their e-commerce site. So they can place the sponsored ad there, and then people can see a product. So the main driver that we see, this main shift, is firstly the new data privacy laws and updates by Apple. So these laws will make it harder for like Facebook and Google, which are now the duopoly in the digital ad market in the US. So it makes them harder to track user data because of all these new privacy laws. And if Facebook is unable or Google is unable to get good data, it means that the advertisers can't really target people properly, and that ads will not be as good. Okay, so how this benefits Amazon is that it makes it more appealing, because Amazon data is very valuable, because they have not only do they know what people bought on their e-commerce website, but they know what people want to buy. So this data is very valuable to advertisers, and we are beginning to see a shift of advertising spending over to Amazon. So just last year, their market share increased from 8% to 10%. So we think that this can be a huge catalyst for this ad business. And you can see that the ad business in the chart on the left, the red bar makes up about half of their profits. So this will definitely drive the bottom line much higher. And the good thing about ads is that you don't really need, it doesn't really cost that much for the ad business. You can just hire like maybe a couple of people just in front of the computer, and you can get it running already. So the cost wise is very low. That's why the margins are very high for this business. And the third point for Amazon is e-commerce. So they are the largest in the US, 40% market share. But it's still growing. It's their core mode, basically. So the warehouse space expected to increase about 44% to 578 million square feet. Just for some context, so this size is about 4 times the size of Ang Mo Kio. So if you want to take that into context, that's the amount of warehouses that they have in the world. And right now Amazon has a 2-hour delivery already in the US. So it may even become shorter, like maybe 1 hour or even maybe a few minutes in the future. So it's very hard to compete with them with regards to this mode. So Amazon, I think, is one of our top picks with a target price of $4,329. Okay, so in conclusion, before we move on to the technical charts, we still see more upside for the tech sectors despite the headwinds. So we still see the secular trends still continuing for clouds and advertising. The forecast are still there, and the demand is still there as well. Secondly, we see that the tech market, or even markets in general, can still perform when interest rates rise. And valuations for the big tech is now near 5-year lows. So I think that the price looks, you won't be over. It's more of an indication that you are not overpaying if you're buying now. For antitrust cases and the new regulations that may affect the big tech, so far it's mostly fines. And what's more important is that these big tech companies are not labeled as monopolies. Because if they are starting to get labeled as that, I mean, if they are officially labeled as that, then governments may actually come in to break them up, or it may even impact their business models even more. But currently now it's still okay. Apple recently won the case against Epic that said that Apple is not a monopoly. So that's good news. So fines are okay as long as they don't affect how the company makes money. So there's a lot of noise now, but you just have to monitor on whether these laws impact the competitiveness of the big tech companies, which we see that it's still okay with regards to the current rulings. Okay, I'll pass my time on to Wei-Ren for the technicals.
All right, thank you, Tim. So just give me a moment, right? So yeah, the technical views today. So basically today I'll just go through a very simply lookout on the Nasdaq because our focus is on really the tech, and then how well, like what Tim has stated in the conclusion, tech is a near 5-year valuation low. So it coincide with what the technicals is saying really. So without further ado, I think let's let's bring it on to the chart. Then I will show why the tech has a very long-term growth. So first of all, I think with tech, I think we are more familiarized with is the Nasdaq Composite Index or the Nasdaq 100, right? So for the Nasdaq 100, you can look at it. We are actually based on the wave theory. We complete the first subset of the 5 wave. So 1, 2, 3, 4, 5 A, B, and C. And last week it did rebound from this resistance and support zone line at 14,200 and 14,429 region on the upside. Okay, so sorry guys, it's a bit sensitive, the mouse. Try a new mouse today. God, sorry guys. Okay, so okay. Just give me a moment. Yeah. Okay, so you can see that the resistance and support zone. Sorry guys, my mouse is a bit sensitive. Just change a new file mouse to try. Apologies guys for the technical fault. All right. Okay, so you can see that the V-shaped rebound has been broken up on this 14950. But the main thing right now is the resistance zone that we are seeing over here. It's around the 15,000 region. So if this region is rejected, first of all, the price action will suggest that there's an inverted there is a larger head and shoulder forming. And then if there's a strong correction down at near this resistance zone, then there will be a larger 3-wave down again. So instead of ABC and then impulse wave up, we have a WXY corrective wave. But if that happens, all right, I'll think that this resistance and support zone will held up at most. All right, and then another thing is the threat of a potential head and shoulder being formed will likely be just a false breakout, touch a lower base of the support between 13,879 region before rebound on the upside. So this is the worst case scenario that I have. The best case, it breaks up, and then I think that it may be, all right, is that you break up because of the strong momentum you can see over here going to the upside. All right. I'll show, sorry, I think I'm muted. Okay, so yeah, the next one is I will show the Ichimoku. So the Ichimoku has really shows a much more clearer picture of what's the likelihood of the daily the short-term period going forward for the Nasdaq Composite Index. Okay, so just now I mentioned the head and shoulder formation, the V-shaped rebound. If it breaks the major resistance line, it will be a jolly well be a very strong bull trend. Why is it so? Because you see that the Senko span A, which is upper boundary of the Kumo, is actually closely what you call it confluence with the lower boundary of the major resistance zone. Okay, so if it breaks up, okay, you will not only invalidate the threat of the ongoing potential head and shoulder. In fact, it will just be in fact it will just break up on the upside and then clear at 16,000. All right, so if this trajectory come to pass, major resistance go on the downside, and then there's a rejection down, you'll go down to the major resistance and support zone at 13800, and then before rebound, like what I mentioned earlier on just now. But do take note that prices remain in a range bound. Despite that price went into the Kumo, it's much more turbulence right now. So on the hindsight, we are very cautious about it. All right, but although I'm very confident that next Monday when the market open for business, it will actually trend higher on this retrospect. Okay, the good thing is the candle yesterday actually gaps up above the Kijun Sen. Right, is the 26 periods like some sort of like closest count average line. All right. So the next one is Microsoft. Microsoft, the another one is Google, which I'm very bullish on it. Okay, so for Microsoft, why am I bullish? Okay, if you look at the whole wave structure, right? The intermediate phase 1, 2, and then we have the third wave over here has yet to complete. Okay, so if you look at the you subdivided the wave count. We are for this after a complex 5-way triangle, symmetrical triangle for wave 2. We can see that wave 1, 2, and then we have wave 3. Wave 4 rebounded at 280 support region, going up on the upside. And then the good thing is they have closed above the 50-day moving average recently. All right, so here a briefly break the gap below, rebound, and then it actually goes up again on the 50-day moving average right here. So, but right now we are still trending within the resistance zone, but consolidating within it. So there is a threat that we might see that it might just a slight dip and then followed by a rebound. Right, but overall, I'm very clear on Microsoft based on the wave count, based on price action, based on moving average. There is still much more room for Microsoft to grow beyond 150, 350 region. All right. Okay, so the next one is look at the Ichimoku signal. All right. So Microsoft, so Ichimoku has really shown 3 bullish golden cross. In Japanese, it's called the Sayaku Koten. So it means that it is the power of 3, everything combined together, give a very strong bullish signal confirmation. Okay. So first of all, I checked Tenkan Sen and Kijun Sen crossover not recently. All right, and then price actually breaks up, and then you have the Chico span, the lagging span that broke above the candle just recently as well. I think on Thursday, it has broke up recently. And despite the bearish Kumo twist, it lasted for a very short while, and then Senko span A returned back above the Senko span B, forming initial bullish crossover for the Kumo bullish twist. Sorry for the chart being cut off. All right, so you look at the price action, you can look at there's a rounding bottom and V shape. I mean the rebound. So these are all the resistance line that is being that need to be broken up above to clear to confirm the rounding bottom and V shape. When you look closely, that there's a multiple testing of the resistance line at 305.94. All right, and then this task has weakened the resistance line, and therefore we think that there is a chance that short-term period we're looking at $320 in near-term target. All right, another thing I want to bring you across is the price action of it. So just now, remember, just now I mentioned that there's a break above the 50-day moving average return above. So I just want to bring back the attention over here where I circled. So on Thursday, it actually gaps up and then close above $300 psychological resistance level. Is a very strong and good sign that the stock will likely go forward again. Okay, so this is a very good sign for Microsoft actually. So I mentioned here Thursday small gap up above 300 psychological level, indicate very high level of bullish activity going forward. Okay, so now I go back to Apple. Although Apple does, from a glance, Apple doesn't look very attractive in the technical perspective. Prices below the Kumo, Tenkan Sen, Kijun Sen is below as well. Lagging span is below as well. So it shows like there's a bearish signal. But one thing that I think we can really, based on the valuation that what Timothy actually shared just now, you consider that, and then you go deeply and then go analytically into the chart of Apple, a daily chart of Apple, you can see that present a very high risk high risk to reward ratio kind of trade as compared to Microsoft, although I'm very bullish on Microsoft. But you look at Apple, all right, so Apple, yes, no doubt it goes down, has a strong downtrend. I can see that first thing, the morning star actually gets above the last candle of the morning star gets above the Tenkan and Kijun Sen. All right, so a successful candle yesterday closed to confirm the morning star. Not a strong one, but yes, it provides a very a good probability and a high confidence for that. All right. Second thing is based on price action, falling wedge has broken. So I plot out the range box over here. So there are resistance need to be broken, no doubt. And then immediate resistance at 147 to 150 region, selling need to be cleared. If it don't clear, it will be a really a larger head and shoulder pattern forming. And then this major support at 132 to 137 is actually a neckline resistance. Okay, so one thing good is about Apple is price remain elevated above the major support. All right, breaking out the falling wedge is a very clear signal. So once it break up above the immediate resistance, expect some form of consolidation, maybe slight correction before carrying out onto the 165. I do have a report on Apple, Microsoft, and most of the FANG stock. You can head over to our website, stocksbnb.com, to actually take a look at it. All right, that's the good thing that I see. Okay. All right, so Facebook. All right, Facebook is one of the stock that I covered, which I post a report on. Okay, but the thing is, Facebook initially was good. I think I posted a report on Tuesday or Monday. All right, I can't remember when. The bullish hammer rebounded up on the upside, and then there's like some sort of rebound going on over here. But yesterday bearish candle pushes it down. So my only hope is that support zone do remain. Right, we do see a stochastic oversold crosses, but recently this week it has been sluggish. All right, momentum has been sluggish. Okay, so the only hope I have is it cross above the 20 above the 20 oversold line. Then we will see there's a significant upside. But do take note that wave that there's a last leg of wave C, so we might think that $300 will be the psychological support again before on the upside. Obviously, if this one is we want to take it as an impulse bullish up move, we want to make sure that it closes above 360 resistance line. All right. Okay. All right, Google is also another one that I'm very strong on. First of all, it has already broken out of the immediate downtrend line. This you can see this little hammer hangman over here. There is a possibility that it may correct and then rebound. All right, like Microsoft resistance zone is kind of weakened. My near-term short-term target is at $3,000 actually. All right, there's a rounding bottom. It's like you can say that this is a head inverted head and shoulder as well, but it's on an uptrend, so it's not very strong on that. But I want to bring your attention to the Ichimoku Kumo over here. Although price rebounded at Senko Span up, so if this is able to cross over Senko Span A, then Senko Span A likely is going to form another bullish cross. Kumo twist, bullish Kumo twist. Like this is a bearish one, this is a bullish one. It's like what we saw in Microsoft actually. So in this retrospect, if there's a rebound over here, like there's some that I foresee there might be some consolidation, followed by a deep retracement back to the downward slope of the downtrend line, and then before rebound upside to 3,000. All right, MACD also showed a cross, although it has yet to cross above the zero line, but histogram has really seen much increase of it. So the histogram is actually the MACD line and the signal line of the distance, all right, the average distance of it. And then if this increases, it means that it's a good sign of it, all right. And then you can see that prices making a higher low, sorry. And then once it crosses zero line, and we can confirm that Google is on the upside. Okay, so this is our US research equity team. Timothy is actually Timothy and John will cover most of the hardware and software companies, and then for me, I'll do most of macroeconomics, and then mostly on technical analysis. So with that, I'll pass on my time back to Timothy or Jonathan to take on the Q&A. We have limited time, so the time is yours. All right, Tim and Jonathan, thank you.
Thanks, Aaron. We'll move on to Q&A. Okay, we'll just try to take as much questions because of the time constraints. The first question will be, hi Timothy, what is the difference between owning a cloud provider and data center REITs? Are they mutually exclusive? Thanks. I'm not so sure about the business model about REITs, but the REITs, I think they just, because some of the cloud providers actually lease their data centers from REITs. And it depends on what kind of REITs is. So I think for Keppel DC REIT, what they do is they just maintain the building, but then the cloud providers bring in all their equipment and stuff. So it really depends on the model that the REIT has about the upside, but I'm not so clear about this. Maybe you can ask Natalie, our REITs analyst. Okay, next question. Which stock among the stock picks do you see as having the longest runway for growth? This interesting question. So we really like Amazon because there's there's a big shift in the advertising space currently. First of all, because it's moving from third party because of all the privacy regulations and laws, right? So it's shifting people to move into Amazon's first party seller data. That's the first shift. The second shift is because they're just number one in the cloud, and they're growing in one of the fastest growing segments in the cloud space. But I think the overhang for Amazon would be the e-commerce business, because the e-commerce business doesn't really generate much profits. But if you just look at how fast the other businesses are growing, we think that Amazon has one of the highest potential. Jonathan, what do you think?
Yeah, definitely Amazon, because for the other companies like Facebook and Netflix, Facebook, they've got 3.6 billion users. I mean, there's only so much they can grow in terms of revenue, and it's only focused on ads. In terms of Netflix, we also see there is a bit of limit compared to Amazon in terms of growth. So definitely, in terms of growth, definitely Amazon would be our winner.
Okay, thanks. Could you share what are the companies that you think will benefit from the 5G trends? I think Apple, first of all, but also the cloud companies, right? Because more and more things will be available. Open up, you got AR, VR. Those things will only open up. Autonomous driving. Those things will only open up when 5G infrastructure is in place. So we're not seeing those new things yet. So these cloud providers will definitely can benefit from all these things once the 5G infrastructure is there already. So that's the more of a, we're getting there already gradually. So the cloud providers also. Not really the advertisers, right? The advertisers not really from 5G. Yeah. Next question, Chinese ADRs shares listed in the US markets looks very attractive in valuation after the share price plunge. With crackdowns on Chinese Alibaba, Tencent, any possibilities of these companies being delisted in the US? Or this one, we're not too sure because it's really up to the regulators to talk about this. But not sure what is going on with these Chinese companies. Perhaps you can ask in the upcoming webinar later for the Hong Kong research team. Okay, next question. Is it better to buy individual tech stocks or buy a fund which contains all the tech stocks? Interesting question. So when you buy a fund that contains all the tech stocks, basically the Nasdaq index, what you're buying versus you're buying the big techs, right? The big tech stocks is that you're buying market leaders rather than the whole market itself. So so one point we have for this is that the market leaders are trading at historically cheaper valuations. So that's our point about buying individual tech stocks at the moment, is that the big tech valuations are near historical lows. So, but we think that you still can buy a fund containing all tech stocks. Yeah, Jonathan,
you want to take some from B-Box, the Express Q&A.
Oh yeah.
Tim.
Oh yeah.
I think there's one on Amazon that you already kind of.
Yeah, I already answered that one. I think we answered all of those already. Okay, we just move on back to the Zoom one. So next question, 10-year bond yield rose yesterday and we immediately see muted interest in Nasdaq. The relationship is clearly negative. When did Nasdaq start to ignore the taper tantrum last round? They didn't really, they were not really affected in the taper tantrum actually. It was just flat. So it was gradually going up. So at the end of the taper tantrum, since the start of the taper tantrum and until the end, it was still up 6% or up 7% around there. So and it wasn't really that volatile. So yeah, so that's how that's how the market performed during the taper tantrum. Which of the stocks picks do you think is the least susceptible to the risk from regulators and antitrust authorities? Jonathan?
Yeah, I can take this one. So the company that is least susceptible will probably be Netflix, because first of all, they're not as big in terms of market cap. Second of all, their business model is totally different from the rest of the FANGs. I mean, given that they deal mainly in subscription entertainment, there's very little regulation about it, and big antitrust legislators are not really looking at Netflix right now. So we definitely see Netflix as the least susceptible.
Okay, Alibaba, is it good to go? This one we don't really have coverage also. But since their business is mainly based in China and Hong Kong, perhaps you can ask the webinar later also. Affirm and Airbnb, we also don't cover those stocks, but I think Airbnb should be able to benefit from the reopening trade in just a very general sense. Okay, we really want to look at Tesla, is it?
Okay, so I wanted to type the answer, but since on Tesla, so I'll briefly explain what's the Tesla, like why Tesla is not on our side, because I think compared to Tesla, I think what Tim and Jonathan thinks this way is, I do not know what they think, but I guess, all right, is that compared not the traditional FANGs, the Facebook and FANGs plus Microsoft, and then Tesla. I think the traditional FANGs are much more stable. Their companies are based on is much more, like you see the growth based on technical chart. They have been on a very steady uptrend. Tesla prior to 2019 is always on a downtrend. It's very speculative. I've been monitoring Tesla like way before I joined PhillipCapital. So recently, even after the stock split, Tesla reached a point where it tops around at close to $900 before it corrects itself, and then until today it's still on a corrective range. Recently, it has rebounded, breakout of the pennant, break above my $800 psychological resistance, and yesterday it was a very strong bullish candle, but the tough resistance zone between 832 to 876, you really need to look at it. If we manage to break them, yes, we are looking at 1,000, but yes, 1,000, and then therefore, what is that? Based on wave theory, 1,000 is actually the price that I look at for the terminal wave 5, and then you go into a very strong deep correction ABC, and then maybe you go to a strong double tree like WXY. So that's why we don't really cover Tesla and on that, and I don't really write a technical report on Tesla as well. And then for the Tesla, NIO, and then Ford and GM, all this, I think NIO, I think China released a report that says that there's oversupplies of cars, EVs over there. So I think if you want to look at EVs, right, look at Hong Kong based like what is it, Great Wall Motor, BYD, and then there's one more, 1211, once BYD is and Geely's. Yeah. So that's all I have to share. Right. Thanks. Back to you guys. Thank you very much.
Yeah, thanks, everyone. I think we'll take one more last question due to time constraints. Any other questions, you can just email us or send it into our website. So the last question, why is your Amazon target price so much higher than today's pricing? For Amazon, our valuation method is DCF, discounted cash flow model. We model a growth that is 5% terminal growth rate. And that's slightly higher than the GDP growth rate, average GDP growth rate for the US of 3.2%. Mainly because Amazon is the leader in one of the most fastest growing markets in the US, the cloud space and the advertising space. And so that's why our target price is much higher than today's price, because of the future growth, the runway for the growth in these markets. Okay, so with that, I'll pass the time on to Alice. Thank you all for spending your afternoon with us.